Hey everyone, welcome back to the Daily Gold Podcast. Today we're speaking with Greg Weldon, CEO of Weldon Financial. He produces a number of products for both the institutional and research crowd, and he's one of the top macro guys in the world. And that's why we're having him here today. Greg, how you doing?
I'm great, Jordan. Thanks for the invite. Always a pleasure to contribute.
Well, it's a pleasure to have you on here and get your insight. And the first thing I want to get to, regarding Cyprus, Greg, the perma bulls, of course, say it doesn't matter, it's too small. Meanwhile, the gold bugs on the fringe say it's the beginning of the end of the whole system. So break it down for us. What does it mean exactly going forward?
Well, I think it's somewhere in the middle of all of that. I think that the optimistic view that it's reconciled and past us and onward and upward and it doesn't matter is very, very short-sighted. I think that to think that this is the beginning of the end, the beginning of the end has already begun. So it's just another step along the way in a very, very, very long process. So to break it down to where I think it actually matters, it really doesn't matter right now, but it absolutely matters the next time there's even a whiff of trouble anywhere in Europe. The immediate psychology of the average guy in the street is going to be, holy mackerel, we don't want to be the next Cyprus, run, take my money. I mean, you could see capital outflows from banks. In fact, you're already seeing it. Why hold, more than a certain amount of money in a bank if it's, subject to being seized? I mean, it really is that simple. It is the gold bug fear of the century. So, from that perspective, it plays. It absolutely plays. And I think that you have some interesting things going on in Europe right now. We've been saying really since the fourth quarter of last year that a litmus test was coming for the ECB to live up to their promise to whatever it took to defend the euro. And I think the crack is there now, thanks to Cyprus, and see how that crack widens from here. And we're specifically focused on Italy right now, as you know.
Right, and getting into my second question, quickly here, getting into the markets and especially with gold and hard assets, something that I've been noticing, looking at a lot of charts, Greg, is, if you actually look at the price of gold and just the price of commodities, the CCI, I use the CCI and not the CRB because the weightings of the CRB they're so outrageous in my opinion. If you look at hard assets and just price it against the inverse of the dollar or the basket that makes up the dollar, the basket of foreign currencies, it's actually looking fairly healthy. A couple days ago, I saw that the CCI priced against the inverse of the dollar actually hit a 3 or 4 month high in terms of the daily closing price. And I'm not saying this is really significant, but to me it just says that the strength in the U.S. dollar is really just the big weight that's holding back hard assets. So can you kind of reconcile that with maybe what's going on in Europe and then with Japan, with their massive money printing that they just started?
Yeah, sure. That's a mouthful and a lot of good points in there. So let's try and hit on them. When you talk about the dollar, I think that there are many, many interesting little dinks, if you will, divergences out there. Primary among them, is the stock market. If you look at, for example, you take the gold adjusted price of the dollar index, the value of the dollar index divided by the price of gold, and you overlay it against the inverse of the S&P. It's a very tight correlation. Dollar debasement against gold leads equities. It tends to be bullish for equities. We know that. Right now, in gold-adjusted terms, the dollar looks strong, just on a flat chart, and of course we can talk all day about how much of that's a euro impact, and we will. But nonetheless, when you adjust it by the price of gold, it looks different. It has not rallied anywhere near the same degree that the blatant flat price dollar index has, and I think that's interesting because now it's starting to. Okay, so if you're sitting here thinking, dollar weakness, dollar debasement from QE is the, reflation play, and that's what's bullish for equities, well, you don't see gold going up, and you see the dollar going up. So that suggests, you have rotation of capital, it's going out of bonds, it's coming out of gold, it's going into equities. This is what the Fed has wanted. They want you out of the safe havens and into risk assets. This has been their goal, they're accomplishing it, and now if you listen to them, now they're a little bit concerned that, hey, we don't want to create a whole bubble, back in the stock market. So that's number one. You talk about, too, in terms of the dollar and its relationship with gold and something like copper, for example. We see the dollar rallying, and in this case, it really gets back to the euro. The euro is breaking down. I think this thing in Cyprus, if you look at the Italian bond market, for example, the BTP futures market, you can look at the cash market. I look at the 10-year BTP futures because I can trade them. It had a near outside reversal day on Monday. Big up, tail, candlestick chart, lower close, major reversal pattern into a Fibonacci retracement level. A lot of technical jargon. The bottom line is that the situation in Cyprus, when resolved, was a negative for the Italian bond market. You have a political situation in Italy where I can tell you, knowing a little bit about some of the characters involved, okay, these guys are not backing down from their positions. There's no quick bargain to be had here politically. That's a major, major problem when you have a ton of debt to sell and you're supposed to be implementing, additional austerity measures. Now, fiscally, from a year-to-year deficit standpoint, they're not too bad. It's their debt, and it's the rolling over the debt the way they did it last year, rolled everything in short-term bills. So not only do you have the stuff that was longer dated coming due this year, you have the stuff that you only rolled over for a year last year coming due. You had a sloppy auction this morning. I'm really watching the Italian stock market's breaking down. All the banks are breaking down. You bring the whole psychology of Cyprus like we first talked about, and that to me is a real potential situation where the euro really is at risk here. And I think that if you look at a chart of gold priced in euro currency, it looks pretty good. Certainly, we know gold and yen is already higher because of the BOJ taking the lead in terms of global central banks. The real, again, litmus test comes with the ECB. What happens if you get another sloppy auction or two in Italy and then one in Spain? You have a lot of landmines in Europe. Let's not forget other places that have potential problems that you don't necessarily think about, like Belgium, where their debt to population is higher than Italy's. Okay, so you have a potential lot of problems that the ECB is going to have to eventually deal with. Should they deal with it in the way that might be anticipated, that would be interesting to see, because I think that would be bullish for gold and euro. So that's our focus right now, is to be long gold in the euro currency.
And just to follow up on that, Greg, I mean, a couple of things here. You're basically just saying that what you're watching for is to see if Cyprus is going to be a trigger for more problems in Europe. And I know it's only been, a couple of weeks or so, but I mean, it looks like, based on what you're looking at.
Well, let me actually interrupt you and stop you, because no, I don't think it's a trigger. It's not a trigger at all. I mean, the triggers are these things themselves: Italian debt, Spanish austerity against the Spanish macroeconomy, against 56% youth unemployment. I mean, the triggers are all over the place. Okay, and when you start to see Germany, the macroeconomy, no manufacturing has kind of rolled over, trade has kind of rolled over. You saw a couple of bad months of employment, then you had a couple of good months of employment. The PMIs that were just released last week were terrible. And on the back of that, if you backload to places like Poland, Czech Republic, Slovakia, Slovenia, these places, European Union countries, that derive a lot of their income from exporting semi-manufactured products to Germany for remanufacture for export. This is the kind of German export juggernaut. The tentacles reach back to places that all of a sudden are showing really, really poor macroeconomic numbers. So it's kind of the second derivative. Now you start to see it show up in Germany. You get a breakdown in inflation in Germany, and it all brings you back to the same place, the European Central Bank.
And so, eventually we all know that the central bank is going to have to print a lot of money there. And looking at essentially what gold price in euros is telling us, it's beginning to sniff out what is inevitable. Is that a fair statement? Well,
it's kind of almost interesting. You could kind of create three scenarios, two of which are bullish for gold in euro, and one of which isn't. So, from the perspective of the two that are, it's either the European Central Bank could be handcuffed here. I mean, the realistic view of the ECB is they do have their limitations. Their balance sheet has actually contracted by almost 400 billion euro in just the last 13 weeks. That's a significant decline. It's all the LTRO being paid back. You've already covered the entire expansion linked to the second wave of LTRO in February last year. That's now dissipated in terms of the ECB's balance sheet. It's been paid back. So the degree to which they have some inflexibility, you would say they also have room, okay? And I think the question is, if they don't act, This is where the Cyprus scene plays in, because that Pandora's box of tapping depositors has been opened, and it doesn't matter how much you assure people that it's been closed. They're going to get scared if they get scared, and that's where gold becomes a dynamic where it doesn't even necessarily need the ECB. And then, of course, if it gets the ECB on the back end, that's also positive from the perspective of adding liquidity to the system. A lot more of which, under that set of circumstances, would flow into gold right now than equities, compared to what's happening now, where it's quite the opposite, or at least has been until today.
Hey, Greg, kind of a big picture thought or question here. I'm sure you've noticed this, but if you go back to the major bottoms in the gold market, you have the beginning of the bull market at the end of 2000 or 2001, whatever you want to call it, and then in 2005, and then in late 2008. In each of those scenarios, the price of gold against the other currencies, or just the price of gold in euros, started rising ahead of its bottom in U.S. dollars. So to me, I mean, of course, you don't want to look at one thing and say, okay, well, this is going to be the same this time. But to me, it kind of sets up another potential scenario like we've seen those other three times.
Absolutely, and I think you have that set up, and there's quite a bit of rotation among leaders. Sometimes it is gold in dollars. More often, it's actually gold in yen, believe it or not. And that's the scenario we have right now, because the BOJ, and we talked about this last year on your program at length. I mean, how they would need to expand their asset purchase program several times over last year, which in fact they did. And now with the new regime, taking it a step further, and we see the result is gold and yen at a new high. You overlay these things, there's no doubt that they tend to move together. One tends to lead the other. It is often gold and yen, and in this situation where you have a pretty stair-stepped kind of pattern where gold in dollars is next because the Fed has been aggressive, but not as aggressive. I mean, in terms of Treasury monetization, it's only been about half of QE2. Open-ended, of course, makes it more potentially bullish, and we'll see how that plays out. The bottom line in the U.S. is we know they're taking the balance sheet to $4 trillion. So to get a positive surprise from here, to get something more than what's already anticipated and to some degree being or has been discounted. And then you got Europe, where it is the worst performing of the three. Gold and euro currency had broken its trend line, was below all the moving averages. The moving averages are rolling and curling down. You're breaking trend lines going back to at least 2008, if not in some of the European currencies outside the euro itself, even in worse shape. In terms of gold in those currencies, but now starting to bounce back as it anticipates, gain back on in Europe. Okay, landmines all over the place. Need to take some protection. The gold, and Jordan, the euro had a perfect ABC 61% retracement. You couldn't draw a better textbook correction than the euro underwent the second half of last year. And now breaking down, implying that this is the next bearish wave that should take out the old lows. And, you're looking at least, in my opinion, a test of 122. And that's a decent move from here, let alone if it were to do what we think it's going to do in a bigger picture way, which is break that low.
Now, Greg, getting back to the big picture, I mean, it's been obvious for the past 20 months or so, you've basically had commodities and gold in a cyclical bear market. That's fair to say that. And obviously we've had this strong cyclical bull market in equities the last couple years. I mean, the relationship to me seems really clear. What is going to be the fundamental catalyst that reverses this relationship and tips equities into a cyclical bear and tips hard assets back into another cyclical bull?
I don't know. I really don't know. I mean, to me, you have this rotation going on now, which is dangerous because what it has done, it's lifted sentiment, and you see it. By the way, you can link it to retail sales, you can link it to job growth in places in, for example, Japan, where they've done the most of this. Very clear. It's a domestic consumption-led recovery. Confidence is up, business confidence is up. The people that are hiring are retail stores, eating and drinking establishments. Manufacturing employment remains down. Exports remain, flat at best, while imports are through the roof. So you have this kind of dynamic in Japan, you have it in Great Britain, and you have it in the U.S., where it is kind of a consumer-led boom where it's a feel-good factor that's derived from an appreciation in assets, in the case of Japan, that they haven't seen in like a long time, at least the degree of how fast this has happened, and the degree that they expect it to be sustained, especially. In the U.S. too, where this feel-good factor based on 401k being reflated. I mean, you're back to this level now where people that stayed in the stock market, they've been made whole. People that got out of the stock market, they feel like they've missed out, and it's a very dangerous setup because it's now believed that the driving force is a strengthening economy, and that's a problem because it isn't. Okay, housing sideways at best. I call it stagnation nation, because if you look at housing and labor, the best you can really, from the math, the best picture you can paint is stagnation. You can't paint reflation, not even in housing, not even with the improvement. They're building more homes, sales are up, and to whatever degree the supply relative to sales is down, but there's still a big increase in homes for sale in the most recent reports. And really, to get reflation in housing, you have to get prices above where the degree of leverage was its highest in the housing market, which was at the highest prices in 2006, 7. So that's real reflation you're not going to get. You can get, certainly some stabilization. You've seen it. Some price appreciation for sure from the lows. You've seen it. You're still closer to the lows than you are the highs. You haven't even made it halfway back. Okay, so I don't see that as reflation. All right, to me, it's at best stagnation. And in labor, it's still a chronic unemployment crisis in the U.S. So if you get people plowing back into the stock market based on this, Fed says risk on, and bing, bang, boom, there's a day of reckoning out there in terms of the macro economy. That could be the big problem. Or even more potentially treacherous, and we're not even discussing the biggest elephant in the room, which is, of course, the fiscal issue in the U.S., which is a landmine waiting to be detonated. Is it detonated in 5 days or 5 years? Tough to tell, because they've been able to really string this thing along. So it does become kind of a side burner factor that you tend to forget about when you shouldn't, but let's forget about it for this conversation. When you get to that point where you get where the Fed all of a sudden is under pressure to, tighten policy, because everyone has this feel-good factor and everyone has this, a faulty belief that the economy is strengthening to the point that this is driving equity markets higher. That could be a real tipping point too. So for sure, 350 on the 30-year U.S. bond yield is a key point. And also, you see mortgage rates creep up a little bit, and you see almost an immediate, slide in some of the demand too. You have some of those credit spreads in the U.S. looking a little interesting. So there's some things you can watch to give you some lead on this before maybe the data starts to turn sour, and then you get a kind of another day of a little reckoning in the U.S. stock market.
Greg, before we close, I just want to get your final thoughts, maybe on the technicals in the gold market, the gold price, and not just the very short term, but just looking back the last few years. I mean, I'll throw in my own comment here. And we've had this, to me, it looks, generally speaking, it looks like a bullish consolidation. Of course, if it breaks down, it's not. You have to wait for the break. But what's so interesting to me, Greg, is how negative the sentiment got a couple weeks ago. And gold in U.S. dollars didn't even break below its May 2012 low. To me, that is a really, really long-term bullish divergence. I don't know what you think. Maybe you disagree.
Well, I think that the pattern itself is very interesting because of what you just mentioned. And if you look at a candlestick chart pattern over the past, say, year and a half to 2 years, you see the degree of support that is underneath this market, underneath 1600, really more specifically, below 1575 into the 15 and a quarter range, and really big time tails on these charts. Between 1550 and 15 and a quarter, going back, to the middle of 2012, when we established that low. You see the same exact pattern in silver. 2612, I think, is the number, if I remember off the top of my head correctly. That is that same kind of low that you can equate to the 15 and a quarter-ish. I think it's 1526 in the continuous contract in the gold futures. And you kind of got down there now. And what you did see is you saw some sentiment that got bearish, but people were selling. It wasn't that people were selling their longs. It wasn't that people were getting short this market. Open interest is actually down. So you kind of can see that people are not so willing to jump on board the short side of gold. To me, I ask this question, and my clients will call in, we'll have a conversation, and invariably I'll have to ask them this question. Do you think you're really going to wake up one morning and something has happened and gold is down $100, or do you think there's a better chance you might wake up one morning and something has happened in Europe or somewhere and gold is up $100? I think that most people listening will probably answer the question in the latter, and that is one of the things that does give gold support. And we also know that when we had this previous pattern of tails, very similar to what we're seeing now, just on a much more extensive basis, back in 2012, below 1575. What we learned from the World Gold Council data after that is it was central banks buying gold down there. So that's another key point. What you don't have is the investor right now. You don't have the guy putting putting money into gold as a part of his portfolio. That will come back. I mean, to me, when I think about where's the next $1,000 move in gold, is it going to be to 2,600 or is it going to be to 600? Again, and I think most of us would answer the same way. It's to the upside. So from that perspective, could you break 15 a quarter? Sure. Could you get to 1,300? Sure. Would I be buying with both hands at 1,300? You better believe it.
Well, on that note, Greg, before we close, why don't you let our listeners know how they can get a free trial to your research product? I know if they get a free trial, they can get your video update, your macro metal monitor. Go ahead and tell us.
Sure, thanks, Jordan. Yeah, it's www.weldononline, W-E-L-D-O-N, online.com, and you can sign up for a free trial. We have a bunch of products. The Money Monitor Live is an audio-visual, me pretty much every day. It's just me that does it, so I try and crank them out often as I can, usually coming out every day, talking about global macro, top-down, Europe, Japan, China, U.S., housing, all the stuff we just talked about will be in there. And the link to that is our Trade Lab, very specific ideas, futures, ETFs, currencies, with very specific strategic ideas linked to the macro thought process as well. And then we do what we call a trend tracker for U.S. equities, which is a quantitative tool that shows you trends in the individual stocks in the S&P 500 and the ETF world. That's become a very popular product, as you might suspect, given the uptrend in the equity market right now. And then we do have the macro market update, which is linked to our metal monitor, which is our gold and silver specific product that also is a once a week audio-visual product that covers the metals markets in depth, as very similar to what we just did.
Well, all right, Greg, thanks so much for your time today and your tremendous insight as always. I really appreciate it.
Yeah, my pleasure. Always a pleasure to speak with you, Jordan.